I've made and lost 4 fortunes in my lifetime. In the next 45 minutes, I'll reveal the exact psychological patterns that allowed me to accumulate over $100 million in today's dollars, and the fatal flaws that cost me everything multiple times. This single principle about market psychology is worth millions to those who truly understand it. Jesse Livermore here, and I've been called the greatest trader who ever lived. Let me show you exactly how the markets broke me and how I broke them. The market has no memory. Every day it creates new opportunities and destroys old assumptions. This truth hit me hardest in 1907, when I made $3 million shorting the market during the panic, equivalent to about $86 million today. While others were paralyzed by fear, I recognized the pattern forming months earlier. The signs were there for anyone willing to see them. I started with nothing, a farm boy from Massachusetts who ran away at 14 with just $5 in my pocket. By 15, I was trading in bucket shops, developing my eye for price movements. By 21, I had made and lost my first fortune. By 30, I controlled enough capital to move markets. The pattern repeated throughout my life. Spectacular success followed by devastating failure. Here's what you need to understand. Trading isn't about being right. It's about being right at the right time. In 1929, I correctly anticipated the great crash and positioned myself accordingly. My profits from that single trade would be worth over $1.5 billion in today's money. Yet years later, I would die broke by my own hand. Why share these painful truths? Because the market will teach you these lessons one way or another. Better to learn from my mistakes than repeat them yourself. The same psychological traps that destroyed me are waiting for you. Overconfidence after success, paralysis after failure, the inability to sit tight when you're right. I discovered that successful trading isn't about intelligence or education. The market doesn't care about your degrees or your pedigree. It only responds to action and psychology. I've seen brilliant men ruined by their own intellect, while simple men who understood human nature thrived. What separates winners from losers in this game? It's not the ability to analyze, it's the ability to act decisively while controlling your emotions. I'll show you how I developed a system to do exactly that, and how you can apply these same principles regardless of market conditions. My rules were forged through devastating losses and exhilarating victories. They cost me everything to learn. Today, I'll give them to you without the painful price I paid. Are you ready to understand the real game being played in the markets? Let me show you how it works. I am Jesse Livermore, and I started with nothing but a keen eye for patterns and an unquenchable hunger for success. They called me the Boy Plunger, a nickname I earned by taking bold positions that shocked Wall Street veterans. By the time I was 15, I had already made my first $1,000 trading in bucket shops, those gambling parlors disguised as brokerage firms. I didn't have formal education beyond grammar school, but the market became my university, and loss became my most effective teacher. My journey wasn't a straight line to success, far from it. I've made and lost several fortunes, sometimes within months of each other. In 1907, I made $3 million shorting the market during the panic. By 1908, I had lost it all. Then, in 1929, I made $100 million shorting the Great Crash. That's billions in today's money. Yet by 1934, I had lost everything again. These devastating cycles taught me that trading isn't just about strategy. It's about mental discipline. The market doesn't forgive psychological weakness. I've learned that a trader who isn't in complete control of his emotions doesn't stand a chance. What separates me from the countless failed traders is my ability to admit mistakes quickly. When I'm wrong, I exit immediately. No hope, no averaging down, no emotional attachment to my position. The market will tell you when you're wrong, but only if you're willing to listen. I developed a system based on pivot points, key price levels where the market shows its hand. When prices break through these levels with increasing volume, that's when I strike with maximum force. I don't trade often, but when I do, I commit substantial capital. Small positions make small profits, and I'm not in this game for pennies. Patience is perhaps my greatest asset. I wait until all conditions are perfect before entering a trade. Most traders fail because they're always in the market, always looking for action. I can sit for weeks, even months, doing nothing but observing. That patience has made me millions, while impatience has bankrupted countless others. I never trade based on tips or rumors. The moment you listen to others, you stop listening to the market. And the market is the only voice that matters. News, opinions, forecasts, they're all noise that distracts from the only thing that counts, price action. Remember this, nothing new ever occurs in the business of speculating in stocks. What happened in the past will happen again and again and again. This is because human nature does not change, and human nature is what moves markets. Master yourself, and you master the market. Let me share my most fundamental rule. Trade with the trend, never against it. I've paid millions to learn this lesson the hard way. The market has a direction, a flow, a dominant force, and fighting against it is financial suicide. I developed this principle after nearly being wiped out in 1907. I was convinced the market would collapse, and I was right. But I entered my short positions too early. The market continued rising against my position for weeks, bleeding my capital dry. By the time the crash finally came, I had already been forced to liquidate. I watched the collapse from the sidelines, my prediction correct, but my timing disastrous. The market doesn't reward being right. It rewards being right and in sync with the prevailing trend. After that humiliating experience, I created my trend identification system. First, I identify the primary trend. Is the market moving predominantly up, down, or sideways over months? Then, I identify the secondary trend, the shorter moves within the primary trend. I only enter positions that align with both. When I see the market making higher highs and higher lows, I look exclusively for buying opportunities. When it's making lower highs and lower lows, I look only for short positions. This discipline saved me in 1929. I observed the primary trend shifting in September, and I aligned myself with it rather than fighting it. While others frantically bought the dips, clinging to the bull market mentality, I recognized the new downtrend and positioned accordingly. The hardest skill I've mastered is patience during trendless periods. Markets move sideways about 70% of the time, a fact most traders refuse to accept. During these periods, I step aside. I've learned that capital preservation during unclear trends is just as important as capital appreciation during clear ones. My trend-following approach isn't about predicting, it's about responding. I don't try to catch exact tops or bottoms. I enter only after the trend has clearly established itself. I might miss the first 20% of a move, but I'll catch the middle 60%, which is where the safest profits exist. Remember this, the market will tell you its intentions if you listen. The trend reveals itself through price action, not news, not opinions, not hope. When I lost fortunes, it was invariably because I imposed my will on the market rather than aligning with its natural direction. Trade with the trend, and the market becomes your ally. Trade against it, and it becomes your executioner. I've experienced both. Trust me, the former is infinitely more profitable than the latter. Rule number 2. Wait for the money to come to you. This principle saved my fortune countless times when others were losing everything. I don't chase trades. I wait for perfect setups where the odds are overwhelmingly in my favor. The amateur rushes in. The professional waits patiently. When I was operating in the bucket shops as a young man, I noticed something crucial. The moment most traders felt urgency was precisely when they should have felt caution. Their desperation to catch every move was their downfall. I developed a different approach. In 1907, during the banking panic, I observed the market for weeks without making a single trade. While others frantically bought and sold, I waited. The signs of weakness were clear to me: tight money, falling commodity prices, bank failures. I waited until my indicators confirmed the downtrend. Then I went short. That patience netted me nearly $3 million when the crash finally came. Most traders fail because they can't distinguish between action and productive action. They believe they must always be in a position. I've learned that my capital grows fastest when I wait for the perfect moment, when the market telegraphs its intention so clearly that the trade becomes almost obvious. I call these moments pivotal points, when supply and demand are clearly imbalanced, when the path of least resistance becomes undeniable. These are the only times I commit significant capital. The rest of the time, I sit on my hands. During the 1929 crash, I recognized the pivotal point months before the collapse. The excessive speculation, the dangerous leverage, the public mania, all signs pointed to an inevitable breakdown. I didn't need to predict the exact day. I simply waited for confirmation, then positioned myself accordingly. My patience turned $100,000 into over $100 million. Remember this: the market will always present opportunities. Your job isn't to catch every move, but to catch the significant ones with conviction. When you force trades out of boredom or impatience, you're simply donating to more disciplined operators like myself. I've developed what I call my line of least resistance theory. Markets, like water, follow the path of least resistance. I simply identify that path and position myself accordingly. I don't fight the current, I flow with it. My trading accounts grew most dramatically during periods when I made the fewest trades. Counterintuitive, perhaps, but the mathematics of survival in this game demands selective aggression. Wait for the fat pitch, as they say in baseball. When it comes, swing with everything you have. The market will bring money to your doorstep if you have the patience to let it arrive. Rule number 3. The trend is your friend. This principle saved my fortune during the panic of 1907, when I made one of my greatest killings. While everyone panicked, I remained calm and followed the trend downward, shorting the market with conviction. Let me explain exactly what I mean by the trend is your friend. When I identify a strong market trend, I don't fight it. I align my trades with it. I've learned through painful losses that betting against a powerful trend is financial suicide. The market has momentum, like a massive ocean current. You can either swim with it or be swept away by it. In 1907, I observed the banking system showing clear signs of weakness. Union Pacific stock kept dropping despite attempts to prop it up. I noticed the persistent selling pressure, a clear downtrend forming. While other traders tried catching falling knives, I positioned myself to profit from further decline. I don't predict trends, I observe them. This distinction is crucial. Many failed traders attempt to anticipate market turns, getting crushed in the process. I simply identify existing trends and ride them until they show concrete evidence of reversal. During that 1907 crash, I waited patiently for confirmation that banks were truly in trouble before committing heavily to my short positions. The trend manifests across multiple time frames, daily, weekly, monthly charts. I always align my trades with the dominant trend of my chosen time frame. If I'm day trading, I respect the daily trend. For position trades, I respect the weekly and monthly trends. This approach kept me from being whipsawed during volatile periods. My method for identifying trends remains simple. Higher highs and higher lows constitute an uptrend. Lower highs and lower lows signal a downtrend. I look for price to consistently respect support and resistance levels that align with the trend direction. When these patterns develop, I increase my position size with confidence. The most profitable trends often emerge from fundamental shifts in economic conditions. In 1907, the fundamental weakness in the banking system created a powerful downtrend that persisted for months. I made millions by simply respecting that trend rather than fighting it. Remember this: the market doesn't reward contrarians simply for being different. It rewards those who recognize reality. The trend represents the collective reality of all market participants. Fighting it means fighting the combined force of all market participants, a battle you'll likely lose. When you align with the trend, you harness the market's momentum. You're no longer swimming upstream. This principle alone would have saved countless fortunes throughout market history. It certainly built mine. The trend is your friend until it ends, and I'll show you exactly how to recognize when that friendship is over. Position sizing is the difference between surviving and thriving in this brutal game. In 1921, I had already made and lost several fortunes, and the lesson was painfully clear. It's not just what you buy or sell, but how much. I've watched brilliant men with perfect market analysis destroy themselves by betting too heavily on a single position. Let me be crystal clear about my fourth rule. Size your positions according to your conviction level and overall market conditions. When I'm uncertain about market direction, I trade small. When I see the perfect setup with multiple confirmations, I scale up aggressively. This single principle saved me more times than I can count. In the summer of 1921, I spotted a clear downtrend forming in wheat. The fundamentals aligned with the technicals, a perfect storm. Instead of immediately deploying my entire capital, I started with a modest position. As the trend confirmed itself, I pyramided in, adding to my winning position systematically. Many traders do the exact opposite. They average down on losing positions and take profits too quickly on winners. I never average down. Never. When I'm wrong, I cut the position immediately. When I'm right, I add to it methodically. This asymmetric approach to position sizing is how I turned $10,000 into $10 million. Your position size should reflect your confidence level. I use a simple scale: 1 unit for speculative ideas, 2 units for good setups, 3 units for high-conviction trades, and 4 units for those rare, perfect alignments that come perhaps twice a year. Never exceed 4 units on any single position, no matter how certain you feel. Market conditions dictate your overall exposure. In choppy, directionless markets, I keep my total exposure under 25% of capital. In clear trending markets, I might deploy up to 60%. Only in those rare moments of extreme clarity, like 1907 or 1929, Do I commit up to 80% of my capital? Remember this. The market can stay irrational longer than you can stay solvent. I've seen brilliant traders ruined because they bet too heavily on a correct analysis. Being right means nothing if your position sizing forces you out before the move materializes. The greatest traders I've known all share this discipline. They size positions to survive the inevitable drawdowns. They understand that capital preservation comes before capital appreciation. They know that living to trade another day is the ultimate edge. I've paid millions in tuition to the market learning this lesson. Size your positions correctly, and you won't have to pay the same price. Rule number 5 is perhaps the most important of all my trading principles. Cut your losses quickly. In Chicago, 1925, I learned this lesson at tremendous personal cost. I'd been riding the wheat market successfully for months, building a position worth millions. The fundamentals looked strong. Drought conditions, low supply reports. Everything pointed to higher prices. My instincts told me to stay in the trade, but the market began behaving erratically. I remember sitting in that Chicago hotel room watching the ticker tape with growing unease. Something wasn't right. The market should have been rallying on the news, but instead it hesitated. Still, I held firm. The fundamentals are sound, I told myself. This is just a temporary pullback. That decision cost me over $3 million, a fortune in those days. Later, I discovered large European shipments had been arranged secretly, completely changing the supply picture. The smart money knew before I did, and was already selling while I stubbornly held on. Here's the truth about cutting losses that most traders never grasp. It's not about being right or wrong, it's about survival. When I take a position, I always determine my exit point before entering. If the market moves against me to that point, I get out. No questions, no hesitation, no hope. Hope is the trader's worst enemy. I've seen countless men destroyed because they couldn't admit a mistake. They average down, they rationalize, they pray for a reversal, and their small losses become catastrophic ones. Notice I don't say, take small losses. I say, cut losses quickly. The speed of your reaction matters more than the size. A decisive exit preserves not just your capital, but your mental equilibrium. Nothing clouds judgment like sitting in a losing position, watching your money disappear. After Chicago, I developed a mechanical approach to losses. When a stock hits my predetermined stop point, I exit immediately. No deliberation, no second-guessing. The market has spoken, and I listen. Remember this, the first loss is the smallest loss. Every day you stay in a losing position, you're choosing to lose more money and opportunity. My greatest trades didn't come from holding losers until they turned around. They came from having the capital and clarity to seize genuine opportunities, capital I preserved by cutting my losses quickly when I was wrong. This discipline solved me during the panic of 1907 and again in 1929. While others were wiped out, I walked away with my capital intact, ready to profit from the chaos that followed. Rule number 6 might be my most profitable. Let your winners run. This single principle made me millions in the 1929 crash when I correctly positioned myself on the short side. I learned this lesson through painful experience. Cutting winners short cost me more money than any other mistake in my trading career. In early 1929, I began to sense weakness in the market. The excessive speculation and margin buying reminded me of patterns I'd seen before. While the public remained euphoric, I noticed subtle divergences between stock prices and underlying economic conditions. I started building short positions in overvalued stocks, particularly in the utility and railroad sectors. As my positions moved into profit, my natural instinct, the same one you likely feel, was to take quick gains. The voice in your head says, "Lock in profits now. What if it reverses?" This fear of losing paper profits destroys more trading accounts than almost anything else. I know because I made this mistake repeatedly in my early years. By September 1929, my short positions were showing substantial profits. Had I followed conventional wisdom and taken reasonable profits of 10 or 20%, I would have missed the opportunity of a lifetime. Instead, I let these winners run. When the crash accelerated in October, my positions multiplied several times over. I walked away with approximately $100 million in today's dollars precisely because I didn't cut my winners short. Here's my practical approach to letting winners run. First, I use a trailing stop that gives the position room to breathe, but protects most of my gains. I never set arbitrary profit targets. The market doesn't care about your personal exit point. Second, I scale out partially on strength, taking some profits while keeping core positions. This satisfies the psychological need to realize gains while maintaining exposure to further moves. Third, and this is crucial, I analyze why the position is winning. If my original thesis remains intact or is strengthening, I have no logical reason to exit. The market is confirming my analysis. Only when conditions change should I change my position. Most traders do the exact opposite of what they should. They cut winners short and let losers run. This asymmetry guarantees failure. My success came from reversing this pattern, cutting losers quickly and giving winners the maximum opportunity to develop. Remember this: the truly big money is made in the big moves. These don't happen often, but when they do, you must be positioned correctly and have the discipline to ride them. The difference between a good trader and a great one isn't intelligence. It's the courage to hold winning positions when all your instincts scream at you to take profits. Patient position sizing is what separates the survivors from the casualties. I learned this lesson the hard way in 1907 during the panic on Wall Street. While others were being wiped out completely, I walked away with my largest profit ever, $1 million in a single day, precisely because I had mastered the art of scaling into positions at the right time and in the right proportion. Let me explain exactly how I approach position sizing. I never risk more than 10% of my capital on a single trade. This isn't arbitrary, it's mathematical survival. During that 1907 crash, I watched brilliant men lose everything because they were overexposed. I remember J.P. Morgan himself working frantically to save the financial system, while traders who had bet too heavily were jumping from windows. My method is methodical. I start with a pilot position, just enough to get skin in the game without risking serious capital. I call this my probe into market waters. When I shorted Union Pacific in 1907, I began with just 500 shares. The market confirmed my thesis as prices fell, so I added another 1,000 shares, then another 2,000. By the time I had my full position, I was riding the momentum with the market's blessing. Think of position sizing like artillery fire. The first shot is to gauge distance. The second shot incorporates that information. By the third shot, you're hitting your target with precision. Trading without this calibration process is pure gambling. The fatal mistake I see repeated throughout market history is impatience with position building. Traders get one signal and immediately deploy their entire capital. I watched this destroy accounts during the 1907 crash. Men who might have survived with proper scaling were obliterated because they had no capital left when better opportunities emerged. My rule is ironclad. Never average down on a losing position. This contradicts what many teach, but I'm telling you what works, not what sounds good. If I'm wrong, I exit quickly with a small loss. If I'm right, I add to my position as the market confirms my thesis. This asymmetric approach kept me solvent when the 1907 crash blindsided everyone else. The mathematics are simple. Survive first, profit second. A 50% loss requires a 100% gain just to break even. By limiting initial exposure, I ensure I'm still in the game when the real opportunity reveals itself. During market panics, I've watched traders with superior market knowledge go broke while I profited, not because I was smarter, but because I sized positions with discipline while they bet everything on being right. Remember, the market doesn't reward intelligence, it rewards intelligent risk management. The sixth rule that saved my fortune multiple times is emotional discipline. Let me take you back to New York, 1929. I had accumulated a short position worth over $3 million, roughly $45 million in today's money. The market was showing classic signs of exhaustion that summer, but everyone around me remained euphoric. The papers, the brokers, even my wealthy friends at exclusive clubs, all convinced the bull would run forever. I watched as rational men abandoned reason. Smart businessmen leveraged themselves 10-to-1 buying stocks on margin. Ladies who couldn't read a balance sheet were trading on hot tips from their hairdressers. I recognized this madness from 1907. The pattern was unmistakable. But holding my short position tested my emotional fortitude like nothing before. For months I endured ridicule. "Poor Livermore," they whispered, "he's lost his touch." My position occasionally moved against me, creating paper losses that would have broken lesser men. Each day required iron discipline to maintain my conviction. I developed a specific technique during this period. Every morning before the market opened, I'd sit alone in complete silence for 15 minutes. I'd review my reasoning, examine market facts, not opinions, and reconnect with my analysis. This ritual insulated me from the emotional contagion of the crowd. When Black Thursday finally arrived on October 24th, followed by Black Tuesday on the 29th, the market collapsed exactly as I'd anticipated. I made nearly $100 million in today's dollars, my greatest trade. Not because I was smarter, but because I maintained emotional discipline, while others succumbed to greed. You see, markets don't reward intelligence alone. They reward emotional control. Fear and greed drive most traders' decisions, creating the very opportunities I exploit. When others panic, I become methodical. When others grow euphoric, I become cautious. I've developed 3 emotional discipline practices you can implement immediately. First, never make trading decisions during market hours. Plan your moves before the open or after the close when your mind is clear. Second, maintain a decision journal documenting not just what you did but why, and review it monthly to identify emotional patterns. Third, establish position sizes before emotional attachment forms. Never add to losing positions out of stubborn pride. My greatest losses always came when I broke these emotional discipline rules. In 1908, I lost a fortune when I abandoned my own system during a cotton trade. In 1915, I ignored my stop-loss rules out of arrogance. Each catastrophic loss taught me that without emotional discipline, no trading system can save you. Rule 7. The dangerous countertrend. I learned this lesson the hard way in Palm Beach back in 1934. I was staying at the Breakers, watching the market from my suite overlooking the Atlantic. The view was magnificent, but my focus was on the ticker tape, not the ocean. I'd been riding a powerful downtrend in wheat futures for weeks. My position had grown substantial, too substantial in hindsight. The market had been dropping steadily, day after day, making me increasingly confident. That confidence was my first mistake. One morning, I noticed a slight uptick. Nothing dramatic, just a small counter-trend move. Most traders would ignore it. I certainly wanted to. My instinct told me to hold my position, that this was merely a temporary correction in a dominant downtrend. But I'd seen this pattern before. In 1907, in 1921, and again in 1929. Small counter-trend moves that seemed insignificant until they weren't. I remembered watching fortunes evaporate when traders ignored these early warning signs. Here's what I've learned through decades of trading. Counter-trend moves deserve your respect and attention. They're not always reversals, but they're always messages from the market. When I see a counter-trend developing against my position, I immediately reduce my exposure. Not eliminate, reduce. I cut my wheat position by half that morning in Palm Beach. My broker thought I was being overly cautious. 3 days later, wheat prices surged on unexpected crop failure news. Had I maintained my full position, I would have lost nearly everything. The dangerous counter-trend rule is simple but critical. When the market moves against your established position, even slightly, reduce your risk immediately. Don't wait for confirmation. Don't seek reassurance. Act. I've watched countless traders destroy themselves by fighting counter-trends. They become emotionally attached to their positions. They average down, adding to losing trades. They convince themselves the market is wrong, and they are right. Pure suicide. The market doesn't need to make sense. It doesn't need to align with fundamentals or logic. It simply is what it is. My success came when I finally accepted this truth. In Palm Beach that summer, I walked the shoreline each evening, watching waves retreat before surging forward again. Nature taught me what the market had been showing me for years. Everything moves in patterns of advance and retreat. The wise trader respects both. Remember this: the most dangerous words in trading are, "It's just a temporary pullback." Maybe it is, maybe it isn't. But risking your capital on that assumption is gambling, not trading. I don't gamble anymore. I calculate probabilities and protect my capital above all else. When you see a counter-trend, respect it. Reduce exposure first, ask questions later. Your survival depends on it. The blueprint I developed decades ago remains remarkably effective in today's markets. While technology has transformed how trades execute, human psychology, fear, greed, overconfidence, remains unchanged. I've watched algorithmic trading emerge, yet the same patterns I identified in the early 1900s continue repeating with astonishing regularity. Let me be clear about modern markets. They're faster, but not fundamentally different. High-frequency trading creates noise, not new paradigms. I would simply adjust my timing, not my principles. When I see the S&P 500 breaking resistance after consolidation, I recognize the same pattern I exploited during the panic of 1907. The vehicles change, the behaviors don't. In today's markets, I would focus even more intensely on liquidity. Instant access to capital has only strengthened my conviction that cash reserves represent optionality. During the 2008 financial crisis or the 2020 COVID crash, those with dry powder could acquire extraordinary assets at panic prices, exactly as I did after the 1929 crash. Social media presents the greatest modern challenge to disciplined trading. I would absolutely avoid the echo chambers of Reddit and Twitter. The constant stream of opinions creates a dangerous illusion of consensus. Remember my cardinal rule: The crowd is almost always wrong at major turning points. When Wall Street Bets unanimously declares a stock will soar, I'm already calculating my short entry. Index funds and ETFs have changed market structure significantly. I would adapt by tracking sector rotation more carefully, as these vehicles create correlated movements across entire industries. When I notice unusual divergence, like healthcare stocks strengthening while the broader market weakens, I've found my edge. These rotations telegraph major shifts before they become obvious. Zero-commission trading would not have changed my approach to position sizing. The absence of transaction costs tempts traders to overtrade precisely when patience delivers the greatest advantage. I would still wait for those rare, perfect setups where risk-reward asymmetry is overwhelmingly favorable. Central bank intervention represents the most significant evolution from my era. I would track Federal Reserve policy religiously, knowing that liquidity drives markets more directly than in my time. The phrase, "don't fight the Fed," exists for good reason. When I traded against monetary policy in 1932, I lost substantially. That mistake taught me to align with, not against, institutional forces. The blueprint remains intact. Identify trends early, pyramid into strength, cut losses immediately, and let winners run. Technology changes, human nature doesn't. Markets still breathe, expand and contract on the same emotional cycles I mastered a century ago. I've spent my entire life mastering the markets, and now I want to talk about something equally important: your trading legacy. What will you leave behind when your final trade is executed? What will your track record show? I built my reputation through consistency, discipline, and the courage to make bold moves when others froze in fear. In 1929, I made $100 million shorting the market during the crash, equivalent to billions today. That wasn't luck. That was preparation meeting opportunity. But my legacy isn't just about the money I made. It's about the principles I discovered that stand the test of time. Your legacy begins with your trading journal. I've kept meticulous records of every trade, every mistake, every insight throughout my career. These journals became my most valuable possession, more valuable than any single winning trade. They contain the distilled wisdom of thousands of market battles. Are you documenting your journey with the same dedication? Modern traders have advantages I never had: algorithmic analysis, instant information, powerful charting tools. But these tools are worthless without the discipline to use them properly. The market still punishes the same psychological weaknesses it did in my day. Technology changes, human nature doesn't. I've noticed something peculiar about truly successful traders. They think beyond themselves. They develop systems that can be taught, replicated, and passed down. Paul Tudor Jones, Ray Dalio, and Jim Simons didn't just make fortunes. They built frameworks that outlast them. Your trading approach should be refined enough that you could teach it to someone else. My greatest regret isn't a losing trade. It's the times I abandoned my own rules. I went bankrupt multiple times, not because my methods failed, but because I failed my methods. Don't repeat my mistakes. Consistency is the cornerstone of any meaningful trading legacy. The modern market offers unprecedented opportunities to share knowledge, whether through mentorship, writing, or creating educational content. Find ways to give back to the trading community. The insights you've paid for with your hard-earned money and time are invaluable to others on the same path. Remember this: the size of your account matters far less than the quality of your process. I've seen traders with modest accounts but impeccable discipline build legacies that dwarf those who made millions but lacked consistency. Your trading legacy isn't measured at the peak of your biggest win, but through the consistency of your entire journey. It's built day by day, trade by trade, through unwavering commitment to your principles. What will yours be?